Before we dive in, please remember that this video is for informational purposes only and is not intended as financial or legal advice. The world of insurance is complex and varies significantly by state and individual circumstance. I am not a licensed insurance agent or financial advisor. You should always consult with a qualified, licensed professional to get advice that is specifically tailored to your personal situation. You know the feeling. Your heart sinks into your stomach as you pull the letter out of the mailbox. It has that familiar logo of your auto insurance company, but the envelope feels heavier, thicker. You open it, and the words leap off the page. Non-renewal, rate increase, policy cancellation. Or maybe it was a phone call, the one after that minor fender bender, where the agent on the other end of the line uses a polite, corporate tone to inform you that your premium is about to double, effective immediately. Suddenly, a routine part of your budget becomes a financial crisis. A privilege you took for granted, the simple ability to legally drive your car to work, to school, to the grocery store, is now under threat. You feel singled out, punished, and trapped. You've just been branded a high-risk driver. Welcome to a club that over 30 million Americans are unwilling members of. That's right. By some estimates, nearly 1 in 7 drivers on the road in the USA is considered high risk by insurance carriers. It's a massive, invisible segment of the population, all fighting the same uphill battle for a basic necessity. And the system feels deliberately designed to be confusing, expensive, and utterly demoralizing. But what if I told you that the system isn't random? What if I told you there's a playbook? That the confusion you feel is by design, but that you can learn the rules of the game and start playing it to your advantage? That is exactly why we're here. This isn't just another video telling you to shop around for quotes. This is a masterclass. Over the course of this series, we are going to pull back the curtain on the entire, frustrating world of high-risk auto insurance. We will demystify the jargon, expose the hidden traps, and arm you with the specific knowledge and strategies you need to not only find affordable coverage right now, but to clean up your record and escape the high-risk category for good. We're going to give you a roadmap out of this expensive maze. So why is it so ridiculously hard? Why does one mistake or even just bad luck feel like a financial life sentence? The answer is simple, but it's not personal. It's math. Cold, hard actuarial math. To understand your struggle, you have to first understand the fundamental business of insurance. Think of a giant insurance company not as a service provider, but as a casino. A very, very sophisticated casino. Their entire business model is based on one thing: placing bets. Every single policy they write, from the teenager with his first car to the grandmother who only drives to church, is a calculated bet. They are betting that the money you pay them in premiums every month will be more than the money they eventually have to pay out for your claims. For most of their customers, the so-called preferred drivers, it's a great bet for the casino. These are people with clean records, good credit, and a long history of safe driving. The odds are overwhelmingly in the insurance company's favor. They collect premium after premium, year after year, and rarely have to pay out a major claim. It's like the house edge at the blackjack table. A slow, steady, predictable profit. But then there's you. Maybe you got a DUI. Maybe you racked up a few too many speeding tickets in a short period. Maybe you were found at fault in an accident, or you let your coverage lapse for a few months because money was tight. Whatever the reason, you are no longer a safe bet. In the eyes of the insurance casino, a giant flashing neon sign has just appeared over your head. It says, "High probability of a payout." You have just demonstrated a pattern of behavior that their data, decades of data from millions of drivers, shows is strongly correlated with future claims. You've gone from being a predictable source of profit to a major financial liability. A wild card. And the casino has two choices when a wild card walks up to the table. First, they can dramatically change the odds. They can charge you an astronomical price to place the bet. This is your high-risk premium. They're not just charging you for your future risk. They're charging you to offset the losses they anticipate from the entire pool of high-risk drivers they're forced to cover. You're not just paying for your mistakes. You're paying for everyone else's, too. That's why a single ticket can feel like it costs you $1,000 over the next 3 years. Because in a way it does. Their second choice, they can refuse to take your bet altogether. They can simply walk you to the door and say, "We don't serve your kind here." This is the non-renewal or cancellation notice. The mainstream, preferred carriers, the ones you see advertising every 5 minutes on TV, are in the business of ensuring safe bets. They have no financial incentive to take on significant risk. their entire profit model is built on avoiding it. So they cut you loose. This is the moment of panic. You're legally required to have insurance to drive. But the companies you've known your whole life suddenly want nothing to do with you. Feels like you've been blacklisted from an entire industry. And that's where the real challenge begins. Because you're now forced to venture into a completely different, much murkier corner of the insurance market. The world of non-standard, high-risk carriers. These are companies you've probably never heard of. They don't have celebrity spokespeople or catchy jingles. Their sole purpose is to insure the drivers everyone else has rejected. They are the specialists in betting on long shots. And because they're taking on so much risk, their prices are, by necessity, incredibly high, and their policies are often riddled with limitations and exclusions you'd never find in a standard plan. This entire system, from the risk calculations to the segregated markets, is designed to protect the financial interests of the insurance companies. It is not designed for your convenience or your budget. It's a brutal, efficient machine for pricing risk. And when you're labeled high risk, you are no longer a customer to be courted. You are a risk to be managed. A number on a spreadsheet. Understanding this shift in perspective is the absolute first step to taking back control. The frustration, the anger, the feeling of being treated unfairly. It's all valid, but it won't lower your premium. Strategy will. Knowledge will. Knowing how they see you allows you to change what they see. Throughout this series, we're going to dissect every piece of this puzzle. We'll break down exactly what actions land you on the high-risk list and, crucially, for how long. We'll explore the shadow world of non-standard insurers and teach you how to find the reputable ones and avoid the predatory ones. We'll demystify the dreaded State Route 22 and FR 44 forms, explaining what they are, why you might need one, and how to handle them without breaking the bank. We'll cover the impact of your credit score, your zip code, and even the type of car you drive. Most importantly, we will lay out a step-by-step, actionable plan to rehabilitate your driving record and your insurance profile. We'll show you the defensive driving courses that actually matter, the telematics programs that can prove you're a safe driver, and the timelines you need to know for when your past mistakes will finally stop haunting your rates. This is your path back to the world of preferred rates and standard carriers. It's not a quick fix, but it is a clear path. The journey starts now by understanding the very first move you need to make. So what is the single biggest, most costly mistake that newly labeled high-risk drivers make the second they receive that dreaded letter or phone call? It's an instinctive reaction that feels like the right thing to do, but it can trap you in a cycle of high premiums for years to come. And that's exactly where we're going next. It's the panic button. The moment that letter lands in your hands, or that phone call ends, your brain floods with cortisol. Your heart rate spikes. The world shrinks down to a single terrifying thought. I'm going to lose my insurance. I won't be able to drive. I'll lose my job. My life is over. And in that state of pure primal fear, you do the most natural, most understandable, and most financially catastrophic thing possible. You immediately start searching for a replacement. You grab your phone, you type in auto insurance for bad driving record, or DUI insurance, and you click on the first link that promises you a solution. You call the first number you see on a late-night commercial, the one with the friendly voice that says, "Accidents? Tickets? DUI? No problem." You're not looking for the best deal. You're not looking for the right policy. You're looking for a life raft. And these companies, the ones that specialize in high-risk drivers, they know this. They aren't just selling insurance. They are selling salvation. They are selling you a solution to your immediate, overwhelming panic. Let's paint a picture. Meet David. David is a good guy. He's a contractor, works hard, has a family. One night he goes out with friends, has a couple more beers than he should have, and makes the worst decision of his life. He gets behind the wheel. Flashing lights appear in his rearview mirror, and a few hours later he's facing a DUI. The legal nightmare is one thing, but a few weeks later, the secondary crisis hits. He gets a certified letter from his auto insurer, a household name he's been with for 10 years, a company he's paid thousands of dollars to without a single claim. The letter is cold, impersonal. Due to a significant change in his risk profile, his policy will not be renewed. It expires in 30 days. The panic is instant and suffocating. He needs his truck for work. He has to drive his kids to school. Not driving isn't an option. So he does what we just described. He goes online and finds a company that advertises second chance auto insurance. He calls them. The agent on the other end of the line is incredibly understanding. He doesn't judge. He just says, Don't worry, David, we can get you covered. We help people in your situation every day. Feels like a weight has been lifted. The agent asks a few questions, taps on his keyboard, and comes back with a number. Okay, David, to get you the state minimum coverage, you need to be legal on the road. It's going to be $450 a month, with a $1,000 down payment. $450 a month. That's more than his truck payment. It's a gut punch. Before the DUI, he was paying $90 a month for full coverage. Now he's being asked to pay 5 times that for a policy that barely covers anything. He hesitates. He asks, "Is that the best you can do?" And the agent, still with that calm, reassuring voice, says, "For now, David, this is what it takes to get you back on the road. The most important thing is to avoid a lapse in coverage. We can get you insured today, right now, over the phone." And that's the hook. The agent isn't selling a price. He's selling a solution to the ticking clock. David, feeling trapped and seeing no other choice, pulls out his credit card. He pays. He's insured. He can breathe again. But he just walks straight into a trap that will cost him thousands of dollars over the next several years. What David doesn't understand is that he just entered a completely different universe of auto insurance. This isn't the standard market with its funny commercials and celebrity spokespeople. This is the non-standard or subprime insurance market. These companies have a business model built entirely around insuring the people everyone else has rejected. Their entire mathematical framework, their risk pools, their pricing algorithms, are designed for a population that is statistically more likely to get into accidents and file claims. Think of it like this: the standard insurance market is like a wholesale grocery store. They buy in massive bulk, millions of safe, reliable drivers so they can keep their prices low for everyone. The non-standard market is like a 24/7 convenience store in the middle of nowhere. They serve a smaller, more specific group of customers who need something right now and have no other options. And just like that convenience store, their prices reflect that specialized high-risk service. Everything is more expensive. So David's first mistake wasn't just accepting a high price. It was jumping into the first most convenient and most expensive pool without ever checking to see if there were other options. He reacted to the fear, not the facts. He let the insurance company's urgency become his urgency. But it gets worse. This decision has a ripple effect. When David accepted that $450 premium, he did something incredibly damaging. He established a new baseline for himself. In the interconnected world of insurance data, that information doesn't just disappear. Future insurance companies, when they pull his records, might see his insurance history. They can see what he's been willing to pay. It's an unconscious anchor. If another company sees you're already paying an astronomical rate, are they going to be super motivated to cut that rate by 80%? Or are they more likely to come in slightly underneath it, say at $400, and frame it as a great deal? By taking the first offer, David essentially told the entire market, "I'm desperate, and I'm willing to pay this much." He lost all his negotiating power before he even started. He set the bar for his own financial pain, and now he has to spend years trying to lower it. This is the desperation tax. It's a premium you pay not just for your driving record, but for your panic. And it's a tax that can follow you for a long, long time. The system is designed to capitalize on that moment of weakness, to convert your fear into their profit. The friendly agent on the phone isn't your friend. They are a salesperson executing a very effective, time-tested strategy. They find your pain point, the fear of being uninsured, and they press on it until you agree to their solution. So what was David supposed to do? Just let his insurance lapse? Of course not. The secret isn't to avoid getting insurance. It's to change the entire process of how you shop for it. It requires a fundamental shift from a panicked, reactive mindset to a calm, strategic, and informed one. It means understanding that you have more time and more power than you think, even when it feels like your world is collapsing. That 30-day notice from his old insurer wasn't a death sentence. It was a grace period. It was a 30-day head start to build a plan. Instead of spending 5 minutes on a frantic Google search, he should have spent the first 24 hours doing something else entirely. Something that costs nothing but is the single most powerful weapon a high-risk driver has in their arsenal. He needed to stop looking for an insurance policy and start looking for information. Specifically, he needed to understand exactly how the insurance world now saw him. Not as a person, but as a collection of data points. Because in the world of high-risk insurance, your story doesn't matter. Your remorse doesn't matter. All that matters is how their algorithm scores you. And if you don't know your own score, you are walking into a negotiation completely blind. You're playing a game without knowing the rules, let alone how to win. The mistake is thinking the problem is finding a company that will say yes. The real problem is finding the right company at the right price by following the right process. David's panic call was step 1 in the wrong process. He started the journey at the finish line, and it cost him dearly. So how does an algorithm see you? What specific data points turn a preferred driver into a high-risk pariah overnight? And what is the one report, the single most critical piece of paper you need to get your hands on before you even think about calling for a quote, that can change the entire game? This report is your secret weapon. It's what separates the drivers who stay trapped in high premiums for years from those who systematically lower their rates and escape the high-risk category for good. And that's the key we're going to unlock next. So let's pull back the curtain. When you apply for auto insurance, the agent on the phone isn't just taking your word for it. They're not making a gut decision. In the background, in a matter of seconds, they are pulling 2 of the most important documents that will ever be associated with your name as a driver. These documents tell a story, your story, but it's written in the cold, unforgiving language of risk. And understanding these 2 reports is the first, non-negotiable step to taking back control. The first and most well-known is your Motor Vehicle Report, or MVR. You can think of this as your official driving resume, issued and maintained by your state's Department of Motor Vehicles. It's the government's official record of your performance behind the wheel. Every speeding ticket you got, even that one you paid online in 5 minutes and tried to forget, it's on there. The stop sign you rolled through that resulted in a ticket? It's a line item. More serious offenses like reckless driving, DUIs, or driving with a suspended license. They are the headline stories on your MVR, printed in bold, permanent ink. But it's not just about violations. It's also about incidents. Any accident you were involved in where a police report was filed will almost certainly be listed, often with a note about who was deemed at fault. It lists the status of your driver's license, if it's active, suspended, or revoked, and tracks the infamous points that many states use to quantify the severity of your driving infractions. For an insurance underwriter, your MVR is a crystal ball. They use it to predict the future by looking at your past. A driver with a clean MVR is, in their eyes, a predictable, low-risk investment. A driver with multiple speeding tickets, an at-fault accident, and a license suspension? That's not a person to them. It's a pattern. It's a statistical probability of a future claim. It's a flashing red light that screams, charge this person more. Or in some cases, do not insure this person at all. The most crucial detail about your MVR is the look-back period. This is the window of time that insurers are legally allowed to scrutinize. For most standard moving violations like a speeding ticket, the look-back period is typically 3 to 5 years. This means that a ticket you got 4 years ago might still be actively jacking up your premiums today. But for major violations, the window is much, much wider. A DUI can stay on your MVR and impact your insurance rates for 7, 10, or in some states, even more years. It becomes a financial ghost that follows you for a decade. This is why time is both your enemy and your greatest ally in escaping the high-risk pool. Every single day that passes is a day closer to a violation aging off your record and losing its power over you. Now, here's your first piece of actionable intelligence. You can, and absolutely should, get a copy of your own MVR. Go to your state's DMV website. There will be a process to request your official driving record. Do it. You need to see exactly what the insurers see, and you need to check it for errors. Clerical mistakes happen. Accidents can be misreported. A violation that should have aged off might still be lingering. Finding and correcting a single error on your MVR can be the equivalent of getting a $1,000 raise, because it could instantly slash your premiums. But the MVR is only half the story. It's the public record. There's a second, more secretive report that many drivers have never even heard of. And in many ways, it's even more powerful. It's called the CLUE report. That stands for Comprehensive Loss Underwriting Exchange. This isn't a government document. It's a massive private database run by a data analytics giant called LexisNexis. Think of it as the credit report for your insurance history. While your MVR tracks your violations, your CLUE report tracks your claims. Every single auto insurance claim you have filed for the past 7 years is meticulously documented here. It shows the date of the loss, the type of loss, was it a collision, a theft, a liability claim? And most importantly, the amount of money the insurance company paid out. It's a complete financial history of you as an insurance customer. And here is where it gets truly insidious. The CLUE report doesn't just track paid claims. It can also include records of inquiries you've made. Let's say you backed into a pole in a parking lot and put a small dent in your bumper. You call your insurance company and ask, "Hey, I have a $1,000 deductible. The repair might be $1,200. Should I file a claim?" The agent talks you through it and you decide it's not worth it. You hang up, pay for the repair out of pocket, and think that's the end of it. It's not. That phone call, that simple inquiry about a potential claim, can be logged in your CLUE report. To a future insurer looking at that report, it doesn't show that you were being a responsible consumer. It shows that you were involved in an incident. It adds another data point to your risk profile, even if they never paid out a single penny. The CLUE report follows the person and the property. This means it tracks claims you've made on your own policies, but it can also show the claim's history of a specific vehicle, identified by its VIN. This is why a used car that was in a major accident and repaired can sometimes be more expensive to insure, even if it looks perfect. Its history is permanently attached to it like a digital scar. When you apply for a new policy, the insurer pulls your MVR to see how you drive, and they pull your CLUE report to see how often you cost your previous insurer's money. It's a devastating 1-2 punch. A driver with a clean MVR but multiple claims on their CLUE report is seen as a different kind of risk. Maybe they're a safe driver, but they live in a high-theft area, or they have a habit of filing claims for every minor scratch. To the insurer, the reason doesn't matter. The pattern does. The cost does. Just like with your MVR, you have the right to see your own CLUE report. Under the Fair Credit Reporting Act, you are entitled to a free copy every 12 months from LexisNexis. You need to search for it, request it, and scrutinize it. Look for claims you don't recognize. Check the dates and payout amounts for accuracy. An ex-spouse accident that's still linked to your name? A claim that was recorded as at fault when it was the other driver's responsibility? These are the silent killers of your insurance rates, and the CLUE report is where they hide. So now you see the battlefield. It's not a friendly negotiation. It's a data-driven assessment based on these two core documents. Your MVR is your driving rap sheet. Your CLUE report is your insurance claim history. Together, they paint a picture of you as a risk. They are the entire foundation upon which your premium is built. Knowing what's in them is the difference between being a victim of the system and being an informed participant who can challenge it. But knowing what's on these reports is just the first step. The real question is, how do insurers take all of this raw data, the tickets, the accidents, the claims, and distill it down into a single secret number that ultimately determines if you pay $300 a month or $800? They use a proprietary algorithm, a black box calculation that produces something called your insurance score. It's not your FICO score, but it's just as powerful. And in the next part, we are going to pry that black box open and reveal the shocking factors inside that might have nothing to do with your driving, but are costing you a fortune. So let's crack it open. This secret number, this ghost in the machine, is officially called a credit-based insurance score. And the first thing you need to understand is that it's not designed to measure how well you handle a car. It's designed to predict the future. Specifically, it's a tool that insurers use to predict the likelihood that you will file a claim. The industry's logic, backed by decades of their own data, is simple and brutal. People with lower credit scores statistically file more claims. They don't necessarily cause more accidents, but they file more claims. Small claims, big claims, at fault, not at fault, it doesn't matter. The correlation is so strong that they've built their entire pricing model around it. It's like noticing that people who buy expensive gym memberships are, on average, healthier. The membership didn't magically make them healthy. The kind of person who is disciplined enough to save for a premium membership is often the same kind of person who is disciplined enough to exercise and eat well. Insurers are making the same kind of judgment about you. They believe your financial discipline is a mirror of your overall life discipline, which they believe translates to your risk on the road. Whether that's fair or not is irrelevant to the algorithm. The data says it works. So what exactly from your financial life are they looking at? Let's dissect the 5 main ingredients that make up this secret score. The biggest piece of the pie, making up a massive 40% of your score, is your payment history. This is the bedrock. Have you paid your bills on time over the past 7 years? Every single one? A single late payment on a credit card from 3 years ago is a negative mark. A mortgage payment that was 30 days late during a tough month is a bigger one. And the real killer? A bill that goes to collections. Imagine this scenario. You have a perfect driving record. Not a single ticket or accident in 15 years. Last year, you had a dispute with a cable company over a $50 final bill after you moved. You thought it was an error. You called, argued, and thought it was settled. But a clerk somewhere never closed the loop. 6 months later, that $50 debt is sold to a collections agency. You never get the notice because they have your old address. Suddenly, your credit-based insurance score plummets. When your auto insurance is up for renewal, your premium skyrockets by $400 a year. You call your insurance company, completely baffled. You haven't changed a thing. You're the same safe driver you were yesterday. But to their all-powerful algorithm, the fact that a bill went to collections, any bill for any reason, is a giant flashing red light that screams risk. You are now statistically more likely to file a claim. You've been branded not by your driving but by a $50 billing error. The second largest factor, accounting for about 30% of the score, is your credit utilization. This is a fancy term for how much of your available credit you're using. In the eyes of the insurer, a person who has maxed out all their credit cards is a person under extreme financial stress. And a person under stress, the data suggests, is more likely to make poor decisions, maybe even file a fraudulent claim out of desperation. But here's the insidious trap. Let's say you use your credit card for all your monthly expenses to get the rewards points. You charge $3,000 a month, but you have a $5,000 limit. You are a model customer and pay the entire balance off on time every single month. You carry zero debt. But your credit card company might report your balance to the credit bureaus on the 20th of the month, 5 days before your payment is due. So, on paper, it looks like you are constantly carrying a balance of $3,000, a utilization ratio of 60%. Anything over 30% is considered a red flag. So, even though you are completely debt-free and responsible, the algorithm penalizes you. It can't see the nuance. It only sees the snapshot in time, and that snapshot suggests you're a risk. Next up, at 15%, is the length of your credit history. How long have you been in the financial game? The algorithm loves a long, stable record. It wants to see accounts that have been open and in good standing for decades. This inherently penalizes younger people. If you're 22 fresh out of college, you might only have a couple of years of credit history. It doesn't matter if you've been a perfect driver since you were 16. Your short credit history makes you an unknown quantity, a statistical ghost. And insurers charge a premium for the unknown. This also disproportionately affects new immigrants to the United States who may have had a perfect financial record in their home country, but have to start from scratch here. The system sees them not as a blank slate, but as a high-risk proposition. The final two pieces, each accounting for about 10%, are your credit mix and your history of new credit applications. Credit mix refers to the variety of credit you have. The algorithm likes to see a healthy mix, a mortgage and auto loan, a couple of credit cards. It shows you can responsibly handle different types of debt. This means that someone who is proudly debt-averse, who pays cash for their cars and rents their home, might actually get a worse insurance score than someone juggling multiple loans. The system rewards participation, not necessarily prudence. And new credit? Every time you apply for a new loan or credit card, it generates a hard inquiry on your report. A flurry of these in a short period can be a red flag. The algorithm interprets it as a sign of financial distress, that you're desperately seeking cash. So, that decision to shop around for the best car loan rate, or applying for that store credit card to save 15% at the checkout. Each one of those applications left a small but lasting mark, a digital breadcrumb that your insurer uses to paint a picture of you as a riskier client. When you put it all together, you realize your insurance premium is being dictated by a financial doppelganger of you. It's a version of you built from late payments, credit card balances, billing disputes, and the age of your oldest account. It has almost nothing to do with whether you check your blind spot or obey the speed limit. And this is where the fierce debate comes in. Consumer advocates argue that this is a deeply unfair system. It's a poverty penalty. If you lose your job, suffer a medical emergency, or go through a messy divorce, your credit is often the first casualty. And just when you're most vulnerable, this system kicks you while you're down, jacking up your car insurance rates and making it even harder to get back on your feet. It creates a vicious cycle. This is why a handful of states, like California, Hawaii, and Massachusetts, have banned or severely restricted the use of credit in setting auto insurance premiums. They've decided that your wealth, or lack thereof, should not determine the price you pay to legally drive a car. But in the vast majority of the country, it is the law of the land. Your financial DNA is being scrutinized, judged, and used to calculate just how much of a liability you are. But your credit score is just the beginning. The algorithm is just getting warmed up. because after it's finished analyzing your financial life, it starts looking at something even more personal, something you have even less control over. It starts to judge you based on where you park your car at night. And the conclusions it draws from your zip code are just as shocking and just as controversial. Your zip code is a proxy, a stand-in. To an insurance company, it's a shorthand for a whole universe of data points that they believe predict the future. And it starts with the most obvious risk: other people. When you buy insurance, you're not just insuring your own driving habits. You're insuring yourself against the chaos of the world around you. An underwriter in an office tower 1,000 miles away doesn't know if your neighborhood has quiet, tree-lined streets or a 6-lane highway roaring past your front door. They don't know if your neighbors are cautious drivers or treat every stop sign like a vague suggestion. So they look at your zip code. They see a history of claims. They see data on traffic density, accident frequency, and weather patterns. They see a story written not by you, but by everyone who has ever driven, crashed, or filed a claim within those few square miles. Imagine two drivers. Let's call them Sarah and Tom. Both are 35 years old. Both drive the exact same 2022 Honda Accord. Both have a completely spotless driving record. No tickets, no accidents, no claims. Ever. On paper, they are identical risks. But Sarah lives in a dense urban neighborhood in Detroit, zip code 48201. Tom lives in a quiet, affluent suburb outside Ann Arbor, zip code 48103. When they get their insurance quotes, Sarah's quoted a staggering $1,800 more per year than Tom, for the exact same coverage, for the exact same car, with the exact same perfect driving record. Why? Because the algorithm has judged her neighborhood. It sees her zip code and pulls up a cascade of data. It sees a higher rate of vehicle theft and vandalism. That's a straightforward risk. If your car is more likely to be stolen or have its window smashed, the insurer has a higher chance of paying out a claim. That makes sense even if it feels unfair. But it goes so much deeper. The algorithm sees more traffic congestion. More cars packed into a smaller space means a higher statistical probability of a fender bender. Even if you're the safest driver on the road, it's a numbers game. You could be a driving saint, but if you're navigating a sea of a million other cars every day, your odds of being involved in an incident, even one that isn't your fault, skyrocket. The system also analyzes the very roads you drive on. It knows which intersections have the most accidents. It knows which highways are notorious for pileups. If your daily commute takes you through 3 of the city's 10 most dangerous intersections, the algorithm flags you. It doesn't matter if you navigate them with the skill of a professional race car driver. You are present at the scene of the statistical crime, and for an insurer, that's enough to raise your rates. Then there's the weather. A zip code in coastal Florida carries the inherent risk of hurricanes and flooding. A zip code in Oklahoma's Tornado Alley carries the risk of hail damage that can total a car in minutes. A zip code in the mountains of Colorado carries the risk of severe snow and ice. These are acts of God, completely beyond your control. Yet they are baked into the price you pay, tethered to the place you call home. But here is where it gets truly controversial, where the cold logic of data begins to look a lot like something else. Something uglier. Insurers also look at something called litigation frequency. In plain English, they analyze how likely people in your zip code are to hire a lawyer and sue after an accident. They look at how generous local juries tend to be. If you live in an area where people are more likely to seek legal recourse and win large settlements for things like bodily injury, the insurer sees a massive financial risk. They're not just insuring you against a $5,000 bumper repair. They're insuring themselves against a potential $500,000 lawsuit. So, even if you would never dream of suing someone over a minor accident, you are financially penalized because of the perceived litigiousness of your neighbors. You are, in effect, paying a lawsuit tax based on your address. And this is where we have to confront the ghost in the machine. When you combine all these factors, crime rates, population density, traffic patterns, and litigation rates, what do you see? You see a map that often looks disturbingly similar to maps of income inequality and racial segregation. The zip codes with the highest rates are frequently those in lower income, urban, and minority-majority communities. This has led to accusations that using zip codes as a primary rating factor is a modern form of redlining. Redlining was the discriminatory and illegal practice where banks would literally draw a red line on a map around certain neighborhoods, often predominantly Black communities, and deny them services like mortgages. Today, critics argue that insurance companies are creating a similar effect with data. They aren't explicitly saying, "We're charging more because of the racial makeup of this neighborhood." Instead, they're using proxies. They use data points like crime rates and claims frequency that are deeply correlated with decades of systemic inequality, poverty, and underinvestment in those very same communities. The result is a vicious cycle. People in poorer neighborhoods are forced to pay more for the mandatory product of auto insurance. This financial strain makes it harder to build wealth, to afford reliable transportation to get to a better job, or even to move to a better zip code with lower rates. A perfect driver like Sarah in Detroit is effectively subsidizing the risk of her entire community, while Tom in the suburbs benefits from the perceived safety and stability of his. He could be a far more distracted, aggressive driver than she is, but his address gives him a halo of low risk. She could be the most cautious driver in the state, but her address paints a target on her back. Insurers defend the practice relentlessly. They argue that location is one of the most powerful and accurate predictors of loss they have. Their job, they say, is not to solve societal problems, but to accurately price risk. If a zip code generates more claims and more expensive claims, then the people living in that zip code must pay more. To do otherwise would force drivers in low-risk areas like Tom to subsidize drivers in high-risk areas like Sarah, which they argue would be equally unfair. It's a cold actuarial calculation, and from their perspective, it's just business. But for the millions of high-risk drivers, it feels deeply personal. It feels like being judged not on your own merit, but on the place you can afford to live. It feels like a penalty for poverty. The data doesn't care about your story. It doesn't know that you park in a secure garage, that you only drive to work and back, that you're a pillar of your community. It just sees a collection of numbers, a set of coordinates on a map, and assigns you a price based on the accumulated misfortune of strangers who happen to share your postal code. Your driving record can be flawless, a testament to your skill and responsibility, but that record is being drowned out by the noise of your environment. And we haven't even gotten to the most invasive factor yet. The algorithm has judged your car, your driving history, and your home. Now it's about to open up your wallet and look at a number that has absolutely nothing to do with driving, but can have everything to do with the price you pay. A number that can brand you a high-risk driver before you even put the key in the ignition. That number is your credit score. Now hold on. I can already hear the objections. What in the world does my ability to manage a credit card have to do with my ability to safely merge onto a highway? Feels wrong. Feels unfair. Feels like an invasion of privacy. And in many ways, you're absolutely right to feel that way. But to an insurance company, your credit history isn't just a record of your financial transactions. To them, it's a crystal ball. It's a complex, data-driven prediction of your future behavior. And the story it tells them can cost you thousands of dollars a year. This isn't your standard FICO or Vantage score that a mortgage lender looks at. Insurance companies use a proprietary, modified version called a credit-based insurance score. They take the raw data from your credit report, your payment history, your outstanding debt, the length of your credit history, your applications for new credit, and they feed it into an algorithm designed for one purpose: to predict how likely you are to file a claim. Not how likely you are to cause an accident, but how likely you are to cost them money. It's a crucial distinction. The industry's justification for this is built on one word: correlation. For decades, actuarial studies, including a major one by the Federal Trade Commission, have shown a strong statistical link between how people manage their finances and how many insurance claims they file. The data suggests that, as a group, individuals with lower credit scores file more frequent and more expensive claims than individuals with higher credit scores. Their theory goes something like this: a person who is meticulous about paying their bills on time might also be more meticulous about maintaining their vehicle. Someone who avoids taking on excessive debt might be more cautious and risk-averse in other areas of their life, including behind the wheel. On the flip side, they argue that someone under significant financial stress might be more likely to file a small claim for a fender bender that a person with more financial cushion would just pay for out of pocket. Financial stress, they theorize, could also lead to distraction, deferred vehicle maintenance, or a higher likelihood of insurance fraud. So, from the cold, detached perspective of an underwriter staring at a spreadsheet, your credit report is a proxy for your level of personal responsibility and stability. It's a shortcut. Instead of trying to figure out if you're a responsible person, they just look at your history with debt. And if that history has some blemishes, they don't see a person who went through a medical emergency, a messy divorce, or a sudden job loss. They see a red flag. They see a higher risk. And they price your policy accordingly. This is where the practice becomes incredibly controversial. Critics argue that using credit scores is a deeply flawed and discriminatory system. It punishes the poor, penalizes people for life events completely outside of their control, and has a disproportionate impact on minority communities. A single major medical bill sent to collections can tank your credit score for years. Losing your job and missing a few credit card payments can do the same. None of that makes you a worse driver. It doesn't mean you suddenly forgot how to check your blind spot. But to the insurance algorithm, you have instantly become a greater liability. The pushback has been so significant that several states have taken action. California, Hawaii, and Massachusetts have banned the use of credit information in setting auto insurance rates. Other states have placed restrictions on it, for instance, prohibiting insurers from canceling a policy or refusing to issue one solely based on credit, but they still allow it to be used as a major factor in pricing. This patchwork of regulations across the country means that the exact same driver, with the exact same credit history, could see a dramatically different insurance bill just by moving across a state line. Let's make this real. Imagine two people. We'll call them Alex and Ben. They are neighbors living on the same street. They are the same age, have the same level of driving experience, and drive the exact same model of car. Critically, they both have a perfectly clean driving record. No accidents, no tickets, no DUIs. On paper, they are identical risks. The only difference? Alex has an excellent credit score of 800. Ben, after a tough couple of years battling medical debt, has a poor credit score of 550. When they shop for insurance, Alex gets a quote for $100 a month. A fair price. Ben, however, gets a quote from the very same company for $300 a month. That's a 200% increase. Over a year, Ben is paying $2,400 more than Alex for the exact same coverage, despite having the exact same driving history. Why? Because the algorithm has branded him as high risk. His financial struggles have been translated into a prediction that he's 3 times more likely to cost the insurance company money. This creates a brutal, vicious cycle. Ben is already struggling financially, which is why his credit is low. Now he's hit with a cripplingly high insurance premium, a mandatory expense if he wants to legally drive to work. This extra $200 a month puts even more strain on his budget, making it harder to pay down the very debt that's hurting his credit score in the first place. He's trapped. The system designed to predict risk is now actively creating the financial instability that it claims to be measuring. So what are they actually looking at in your credit file? It's more than just whether you pay your bills on time, though that's a big one. Late payments and accounts and collections are major red flags. But they also look at your credit utilization, which is the amount of revolving debt you have compared to your credit limits. If your credit cards are maxed out, that's a negative signal. They look at the length of your credit history. A longer, more established history is seen as a sign of stability. They look at your credit mix, meaning the different types of credit you have, like mortgages, auto loans, and credit cards. And they look at hard inquiries, which happen when you apply for new credit. Applying for several new loans or credit cards in a short period can be interpreted as a sign of financial distress. Every one of these data points is fed into the machine. The algorithm doesn't know your story. It doesn't know about the layoff, the illness, or the emergency that forced you to rely on credit. It just sees the numbers. And based on those numbers, it slots you into a risk tier. Low credit score, high risk tier. And the high risk tier always comes with a high risk price tag. So now we've seen how your actions on the road, the tickets, the accidents, can label you as high risk. We've seen how a DUI can permanently scar your record. And now we see how your actions with your wallet, completely separate from your driving, can do the exact same thing, sometimes even more severely. An insurer's profile of you is becoming clearer. They've judged your driving record. They've judged your financial stability. But they're not done yet. The next layer of analysis gets even more personal, looking at factors that feel even less connected to your skills as a driver. They're about to judge you not just on what you've done, but on who you are and where you live. And the first stop on this personal journey is your own front door. Your zip code. To an insurance company, where you live tells a story about the risks your car faces every single second, even when it's parked. Think about it. 2 identical drivers with identical cars and identical driving records. One lives in a quiet rural town with wide streets and little traffic. The other lives in the heart of a dense, bustling city. Who do you think pays more? It's the city driver, and it's not even close. Why? Because the insurer isn't just insuring you. They're insuring you in your environment. In that dense city, the risk of a fender bender in a crowded parking lot skyrockets. The chance of a sideswipe on a narrow street packed with double-parked cars is a daily reality. The rates of auto theft and vandalism are statistically much higher. Every time you park your car on the street overnight, the insurer's algorithm sees a tiny roll of the dice. In a rural area, that roll is far less frequent, but it goes deeper than just traffic and crime. They analyze local weather patterns. Do you live in a hail alley, where a single storm can cause thousands of dollars in cosmetic damage to every car on the block? Are you in a coastal region prone to hurricanes and flooding? These are considered acts of God, but to an insurer, they are predictable, geographically specific risks that you pay for. They even look at the quality of local road maintenance and the frequency of animal collisions. Hitting a deer is a comprehensive claim. And if you live in an area where that's common, your rate will reflect it. And here's a factor most people never consider: the legal climate of your region. Insurers know, down to the county, how likely people are to hire a lawyer and sue after an accident. They know the average jury award for a bodily injury claim in your town versus the next one over. If you live in a more litigious area, where small accidents often turn into big lawsuits, everyone's rates go up to cover the insurer's potential legal costs. Your address places you on a map of risk, a complex tapestry woven from crime statistics, traffic data, weather reports, and even courtroom records. You haven't even turned the key in the ignition, and they've already assigned a huge chunk of your risk profile based on your geography. From there, the lens zooms in from your neighborhood to you personally, and the first, most powerful factor they look at is your age. This is pure cold hard statistics. Car crashes are the #1 cause of death for teenagers in the United States. According to the CDC, drivers aged 16 to 19 are nearly 3 times more likely to be in a fatal crash per mile driven than drivers aged 20 and over. They speed more. They get distracted more easily. They make more rookie mistakes. To an insurer, a 16-year-old driver is the statistical equivalent of a ticking time bomb. It doesn't matter if you have a perfect, responsible teenager. They are being priced based on the disastrous track record of their entire age group. The rates typically start to fall dramatically around age 25. As drivers gain experience and their brains fully mature, they continue to drop, hitting a sweet spot for drivers in their 40s, 50s, and early 60s, who are statistically the safest, most predictable drivers on the road. But then, something interesting happens. As drivers enter their late 60s and 70s, the rates can begin to creep back up again. Vision may decline, reaction times can slow, and the risk of certain types of accidents, like confusing the gas and brake pedals, statistically increases. It feels deeply personal, but to the company, it's just another data curve on a chart. Next comes a factor that's become increasingly controversial: your gender. For decades, a simple rule applied: young men pay more than young women. The statistical justification was clear and undeniable. Young male drivers were, as a group, far more likely to get into serious accidents. They had higher rates of speeding tickets, DUIs, and reckless driving citations. They were simply taking more risks and costing insurance companies more money. So, a young man would see a significantly higher premium than a woman of the same age with the same car and record. However, the tide is turning on this. A growing number of states, including California, Hawaii, Massachusetts, Michigan, Pennsylvania, and North Carolina, have banned or severely restricted the use of gender in setting auto insurance rates. The argument is that it's a form of discrimination to charge someone more based on a characteristic they can't control, rather than their individual driving behavior. In these states, your driving record is what matters, not your gender. But in the majority of the country, it remains a standard, statistically defended practice. Then they look at your marital status. This one often confuses people. Why would being married make you a better driver? Again, it's all about statistics and predicting behavior. Actuarial data consistently shows that married people file fewer claims than single people. The theory is that marriage is an indicator of stability and responsibility. Insurers assume a married person is less likely to be out late at night, less likely to engage in risky behaviors, and more likely to drive cautiously, perhaps with their family in the car. To an actuary, a wedding ring isn't a symbol of love. It's a data point that suggests a less risky lifestyle. So, 2 28-year-olds with identical records could apply for insurance, and the one who is married will almost always get a better rate. But of all the non-driving factors, the one that generates the most anger and confusion is your credit score. What on earth does your ability to pay your bills have to do with your ability to safely merge onto a highway? Insurance companies have a very specific answer. They will point to mountains of industry data from a credit-based insurance score, which is different from your regular credit score but is derived from it. This data, they claim, shows a direct and powerful correlation. People with lower credit scores are statistically more likely to file claims. Not just more likely to get into accidents, but more likely to file claims of all types, from major collisions to minor fender benders to comprehensive claims for things like hail damage. The insurer's argument is that a person's financial responsibility is a good predictor of their overall sense of responsibility, including how they maintain and operate their vehicle. They also argue that people under financial stress might be more inclined to file a claim for minor damage they might otherwise pay for out of pocket, or worse, be more tempted to file a fraudulent claim. Critics, however, call it a poverty tax. They argue that it's a deeply unfair practice that punishes people for having financial struggles, which could be due to a medical emergency, a job loss, or a student loan burden, things that have absolutely nothing to do with their skills as a driver. It creates a vicious cycle. If you're struggling financially, your credit score drops, which makes your mandatory car insurance more expensive, which makes it even harder to get back on your feet. Recognizing this, a handful of states, again California, Hawaii, Massachusetts, and Michigan, have banned the use of credit scores in rate setting. But for the vast majority of Americans, a poor credit history can add hundreds, or even thousands, of dollars to their annual premium, pushing them towards that high-risk category regardless of their driving record. So they've built this incredibly detailed, almost invasive profile of you. They've judged your past, your car, your neighborhood, even your personal life. And the algorithm spits out a single terrifying word: high risk. What happens next is a journey into a completely different, and far more expensive side of the insurance world. A world of rejections, special policies, and last resort options that most drivers never even know exist. So you've been branded. That single label, high risk, becomes a digital ghost that haunts your every attempt to get a quote. The first and most brutal shock often comes from the company you've been with for years. You've paid your premiums on time, maybe you even bundled your home and auto, you thought you had a relationship. But insurance isn't about relationships, it's about risk. And suddenly you are a bad bet. You'll receive a cold, formally worded letter in the mail. It's called a notice of non-renewal. It's not a cancellation for non-payment, it's a breakup. The letter politely informs you that, upon the expiration of your current policy term, they will no longer be offering you coverage. They'll give a vague reason, citing underwriting guidelines, which is corporate speak for, "You've become too risky for our business model." You now have a deadline, typically 30 to 60 days, to find a new home for your policy before you are legally uninsurable and unable to drive. This is the moment the door to the standard insurance market slams shut in your face. All those friendly, familiar companies you see advertising during the Super Bowl, the ones promising to be a good neighbor or telling you you're in good hands, suddenly their hands are full. Their doors are closed. You start calling around, filling out online forms, and you're met with a series of polite but firm rejections. The algorithm sees your driving record, your DUI, your at-fault accidents, or your license suspension, and it immediately flags you as unacceptable risk. You are, for all intents and purposes, exiled from the mainstream insurance world. This is where you enter a parallel universe, a place most drivers never see. The non-standard auto insurance market. These are not household names. They don't have blimps flying over stadiums. They are specialist companies, financial institutions built from the ground up with a single purpose: to ensure the drivers that everyone else has rejected. They are the underwriters of last resort. Their business model isn't based on attracting millions of safe drivers and hoping for the best. Their model is based on precision pricing extreme risk. They have actuaries who spend their entire careers studying the data of drivers with DUIs, reckless driving convictions, and terrible credit. They know exactly how much more likely a driver with your specific profile is to cause a catastrophic accident compared to a driver with a clean record. And they are going to charge you a premium that reflects that terrifyingly high probability. This is where the second shock hits: the price. It's not just a little more expensive, it is a financially life-altering event. A policy that once cost you $150 a month might now be quoted at $600, $800, or even over $1,000 a month. That's not an exaggeration. We're talking about premiums that can easily exceed a mortgage payment. And why? It's the brutal math of risk pooling. In a standard insurance company, your small risk is diluted in a massive pool with millions of other low-risk drivers. The occasional fender bender is easily absorbed, but in the non-standard market, the entire pool is filled with high-risk drivers. It's a concentrated group of people who, statistically, are going to have more accidents, more severe accidents, and file more claims. The pool is red hot with risk, and every single person in it has to pay an enormous premium to keep it solvent and cover the inevitable, frequent, and expensive claims that will occur. You're no longer paying for the possibility of an accident, you're paying for the statistical probability of one. And just when you think it can't get more complicated, the state often steps in to add another layer of bureaucracy and cost. This comes in the form of a small, unassuming document code, State Route 22. Many drivers think State Route 22 is a type of insurance. It is not. And State Route 22 is a leash. It's a certificate of financial responsibility that your new, non-standard insurance company must file with your state's DMV. It is, essentially, a legal document where the insurance company promises the state that you have at least the minimum required liability insurance. If you are required to have one, usually because of a DUI, driving without insurance, or a major moving violation, you cannot get your license reinstated without it. Here's the cruel catch-22 of the State Route 22. You need insurance to get the form filed. But the very act of needing State Route 22 makes you radioactive to standard insurance companies. They simply won't file them. Their refusal is a business decision. They don't want the administrative hassle or the high-risk client that comes attached to it. So your need for State Route 22 automatically funnels you directly into the non-standard market, where companies are equipped and willing to handle the paperwork for a hefty price. That State Route 22 filing alone can add a significant fee to your policy, and the leash is tight. If you miss a payment and your policy lapses, the insurance company is legally required to immediately notify the DMV by filing another form, State Route 26. The moment the DMV gets that notice, your license is suspended again. It's the state's way of ensuring you are constantly insured without exception for a period of typically 3 years. In some states like Florida and Virginia, there's an even more severe version called an FR44, often required for DUIs, which forces you to carry liability limits that are double or even quadruple the state minimum, making an already expensive policy even more so. So how do you even navigate this hostile new world? You can't just go to a big-name website. The key is often finding an independent insurance agent or broker. Unlike a captive agent who only works for one company, an independent agent has contracts with dozens of carriers, including the entire spectrum of non-standard specialists. They become your guide, your Sherpa in this treacherous landscape. You tell them your story, you show them your driving record, and they do the painful work of shopping your high-risk profile to the few companies that might be willing to take you on. They find the least bad option, the most affordable of the unaffordable choices. But what if your record is so bad, so uniquely catastrophic, that even the non-standard market says no? What if you have multiple DUIs and a string of at-fault accidents? Is it simply impossible to legally drive? No. There is one final, absolute last resort. It's called the state's assigned risk pool, or the automobile insurance plan. This is the option of last resort. It's not a company. It's a state-mandated program. Here's how it works. You apply to the pool, and the state assigns you to a licensed insurance company. That company is forced by law to insure you. Every insurer in the state, from the largest national brands to the smallest local ones, has to take on a share of these drivers, proportional to their share of the market. You don't get to choose your company. You could be assigned to anyone. The coverage is the bare legal minimum required to operate a vehicle, and the price is, without question, the highest you will ever pay for auto insurance. It is the absolute floor of the system, designed only to ensure that every driver on the road, no matter how risky, has the ability to cover damages they might cause to someone else. Being labeled high risk isn't just a financial problem. It becomes a sentence. You're living under a cloud of constant financial pressure, walking on eggshells with the DMV, knowing that one more speeding ticket, one more minor fender bender, could make your situation even worse. But is this a life sentence? Or is there a way back? A path to redemption in the cold, calculating eyes of the insurance algorithm? That is the critical question, and the answer is the key to escaping this high-priced prison. The answer is yes, but it is not a flip of a switch. It's a journey, a deliberate, calculated, and sometimes frustrating climb out of a deep financial hole. This is the road back from the brink, the step-by-step blueprint for turning a red flag into a green light in the eyes of the insurance industry. It requires patience, strategy, and an unwavering commitment to proving that your past is not your future. The first, most powerful, and least satisfying tool at your disposal is time. Time is the great eraser. Every single day you drive without an incident, without a ticket, without a claim, you are actively diluting the toxicity of your record. Insurance companies operate on what's called a look-back period. For a minor speeding ticket, that might be 3 years. For an at-fault accident, it's often 5. For a DUI, it can be 7, 10, or even more years depending on the state and the insurer. Think of your driving record as a rolling average of your behavior. For years, your average was pulled down by negative events. Your mission starting today is to flood that average with an overwhelming amount of positive data points, which in this case are simply days of clean, uneventful driving. It's a war of attrition. You are waiting out the clock on your mistakes. Every 24 hours that pass is a small victory. Another piece of evidence that you are no longer the driver you once were. But waiting is passive. You need to be proactive. Your first active step is one of the easiest and most impactful. Enroll in and complete an approved defensive driving course. Now you might be thinking, a boring Saturday class in a community center? How is that going to help? It helps in 2 critical ways. First, in many states, completing one of these courses can directly remove points from your official driving license record. Fewer points mean you look less risky to the state, which is a signal insurers pay close attention to. Second, and more directly, almost every major insurance carrier offers a specific discount for completing one of these courses. It can be anywhere from 5 to 15%. But the value is more than just the discount. It's a signal. By voluntarily giving up your time and money to become a safer driver, you are sending a powerful message to any underwriter looking at your file. You are demonstrating accountability. You are showing them you are actively trying to mitigate your own risk. It's the difference between saying "I'm sorry" and actively working to make amends. In the world of insurance, actions always speak louder than words. Next, you have to look at the second half of the risk equation, your vehicle. Trying to get affordable insurance as a high-risk driver while owning a brand-new, high-horsepower sports car or a luxury SUV is like trying to put out a fire with a canister of gasoline. It's a financial impossibility. The car itself is screaming risk. It's fast, it's expensive to repair, it's a magnet for thieves. You are compounding your personal risk profile with a high-risk vehicle profile. The strategic move? A tactical downgrade. This isn't about punishment. It's about pure, cold-blooded financial strategy. Sell the expensive car. Use that money to buy a reliable, boring, and most importantly, safe used vehicle. Think Toyota Camry, Honda Accord, or a Subaru Forester. A car that is a few years old, has a high safety rating from the IIHS, is cheap to repair, and isn't on any top 10 most stolen lists. Let's break down why this is a game changer. A cheaper car means a lower replacement value, which dramatically lowers the cost of your collision and comprehensive coverage, the very coverage that protects the vehicle itself. A car with a reputation for safety tells the insurer that you are more likely to walk away from an accident, reducing their potential payout for medical claims. And a sensible 4-door sedan simply doesn't fit the statistical profile of a reckless driver in the same way a 2-door coupe does. You are systematically removing every possible variable that screams expensive claim. You're not just changing your car, you're changing your entire risk narrative. It's a temporary sacrifice for a massive long-term financial gain. With a clean driving commitment and a more sensible car, it's time to go shopping. But this isn't a stroll through the mall. This is a targeted mission. As a high-risk driver, you cannot just go to the websites of the big, primetime commercial insurance companies. Many will reject you outright. You need to enter the world of non-standard auto insurance. These are companies that specialize in the high-risk market. Their entire business model is built around insuring drivers that standard companies won't touch. Their names might not be as familiar, companies like the General, Safe Auto, or Dairyland, but they are your lifeline. Their premiums will still be high. Let's be clear about that. They won't be cheap, but they will be attainable. And they will likely be significantly less than the astronomical quotes you might get from a standard carrier that's trying to price you out of their system. The absolute best way to navigate this is to find an independent insurance agent. Not an agent who works for one company, but an independent one who represents dozens. They are the experts who know which non-standard carriers operate in your state, and which ones are more forgiving of your specific infraction, whether it's a DUI or a string of accidents. They do the brutal work of shopping for you, finding the least bad option available. Your goal in this phase isn't to find a great deal. It's to secure a policy, stay insured, and keep building that all-important history of continuous coverage. Now for the modern-day secret weapon, telematics. This is the technology that uses a plug-in device or your smartphone's app to monitor your actual driving behavior in real time. It tracks things like hard braking, rapid acceleration, the time of day you drive, and your total mileage. For a standard driver, this is a way to get a small discount. For a high-risk driver, this is your golden ticket. It is your single greatest opportunity to prove the algorithm wrong. Your record says you're a risk. Your past actions say you're a risk. Telematics gives you the power to present new, compelling, real-world evidence to the contrary. Think of it as a deal you're striking with the insurer. You're saying, forget what my record says I might do. Watch what I actually do. Every single day. Yes, it means giving up some privacy. They will know how you drive. But you are turning their surveillance into your greatest advocate. A few months of data showing smooth acceleration, gentle braking, and no late-night joyrides is more powerful than you can imagine. It provides the underwriter with a justification to lower your premium at your next renewal. It shows with indisputable data that you are a reformed driver. You are actively creating a new record, a shadow record of good behavior that can begin to override the official one that's holding you back. So, you combine these strategies. You enroll in the defensive driving course. You swap your sports car for a sedan. You work with an independent agent to get a policy from a non-standard carrier, and you immediately sign up for their telematics program. Then you drive. You drive perfectly. For 6 months. At the 6-month renewal, you and your agent present your case. You have your course completion certificate. You have 6 months of clean driving. You have the telematics data to prove it. Maybe your rate drops 10%. Then you do it again. For another 6 months. At the 1-year mark, you reshop your policy. A full year of clean driving is a significant milestone. Maybe now, a different non-standard carrier will offer you a better rate. You keep stacking the evidence. You keep building your case. After 3 years, that first major violation might finally fall off your record. That is the moment you can begin to knock on the doors of the standard insurance companies again, armed with years of proof that you are no longer a risk. You have clawed your way back. This is not easy. It is a systematic, deliberate process of rebuilding trust with a system that is designed to be skeptical. But it is a clear path. You are not a helpless victim of your past. Through a series of smart, strategic decisions, you can take control of the narrative, lower your premiums, and eventually escape the high-risk category for good. But while you are working to fix your individual situation, there are larger forces at play, shifts in technology and society that could fundamentally change this entire landscape. What does the future hold for the very concept of risk? And could the system itself be on the verge of its own transformation? That transformation is no longer a distant whisper on the horizon. Its vanguard is already in your pocket and in your car. It's called telematics. For decades, insurers made an educated guess about you. They looked at your past, your tickets, your accidents, your age, even your credit score, and built a statistical ghost, a profile of who they thought you were as a driver. High risk was a brand, a label stamped on your file based on history. But telematics doesn't care about history. It cares about now. That little plug-in device or smartphone app is a silent narrator of your driving story. It's not judging you for a mistake you made 3 years ago. It's measuring your speed on the curve you took 2 minutes ago. It's tracking how hard you brake, how aggressively you accelerate, the time of day you drive, the routes you take. The old model was a snapshot. This is a live stream. For a driver trying to escape the high-risk category, this is a double-edged sword of immense power. On one hand, it's the ultimate chance to prove yourself. You can literally generate data that screams, "I am a safe driver right now, today." Your actions, not your past, can directly lower your premium. It democratizes redemption. You don't have to wait 7 years for a DUI to fall off your record. You can demonstrate your reform every time you get behind the wheel. But the other edge of that sword is sharp. This constant monitoring raises profound questions about privacy and a new, more insidious form of judgment. What if you're a baker who has to drive at 4 a.m.? The data says that's a riskier time and your rate goes up, punishing you for your profession. What if you live in a densely populated city where sudden stops are a daily, unavoidable reality? The algorithm might flag you as an aggressive braker. The system, intended to be objective, can bake in biases against entire lifestyles and communities. We are trading a system that judges our past for one that scrutinizes our present, moment by moment. The definition of risk is shifting from a static category to a dynamic, fluid score that changes with every turn of the wheel. And this is just the beginning. This is the opening act for the real revolution. Because what happens when the most important factor in the risk equation, the driver, is removed entirely? The rise of autonomous vehicles isn't just an evolution in transportation. It's an extinction-level event for the very concept of personal auto insurance as we know it. Think about it. The entire industry, the very idea of a high-risk driver, is built on the foundation of human error. 94% of serious crashes are due to mistakes made by us. But when a fully autonomous car, a Level 5 vehicle, gets into a collision, who made the mistake? Who is at fault? Is it the person in the passenger seat who owns the car but wasn't driving? Is it the car manufacturer Tesla, Waymo, Ford who built the hardware? Is it the company that wrote the billions of lines of code for the AI, the ghost in the machine making the decisions? Suddenly, the legal and financial liability shifts from an individual's behavior to a corporation's product. Your personal driving record becomes irrelevant. Your past DUIs, your speeding tickets, they mean nothing when you are a passenger in your own car. Auto insurance will likely morph into a form of product liability insurance, bundled into the cost of the vehicle itself or its software subscription. You won't be paying a premium based on your risk profile. You'll be paying for the manufacturer's risk profile. The question will no longer be, are you a good driver? But, how good is your car's code? How reliable is its hardware? The concept of high risk won't disappear. It will be redefined. A high-risk vehicle might be one running an older, unpatched version of its operating system. Your premium could skyrocket if you fail to download the latest over-the-air update that fixes a bug in the collision avoidance system. We could see a world where certain brands of autonomous vehicles are deemed riskier than others, not because of their crash test ratings, but because of their vulnerability to being hacked. The entire financial architecture built around individual accountability will crumble, to be replaced by one built on technological reliability. But this future won't arrive overnight in a clean, orderly transition. We are entering what will likely be the most chaotic and complex period in the history of driving: the messy middle. For the next several decades, our roads will be a wild ecosystem of vehicles with vastly different capabilities. You'll have classic, human-driven cars with no electronic assistance, sharing a lane with cars that have advanced driver assist systems, which are in turn interacting with semi-autonomous and fully autonomous vehicles. Imagine the insurance nightmare of a single accident. A human driver in a 20-year-old sedan swerves to avoid a self-driving vehicle that brakes suddenly. The human driver hits a third car, which has a lane-keeping assist that tried to correct, but its sensors were confused by the erratic movement. Who is at fault? The human who overreacted? The autonomous car that made a decision that was logically perfect but socially unpredictable? The driver assist system that failed in a chaotic scenario it wasn't designed for? Insurers and the legal system will be untangling these digital and human knots for years. Assigning risk in this hybrid environment will be exponentially more difficult than it is today. Premiums could, paradoxically, increase for everyone during this transition as insurers struggle to model and price an unprecedented level of unpredictability. The high-risk driver of tomorrow might simply be the human driver, the last bastion of unpredictable, emotional, and fallible decision-making on a road of cold, calculating machines. So, when we look at the immense challenge of getting auto insurance as a high-risk driver in the USA today, we are seeing more than just a flawed and expensive system. We are seeing a system at the absolute peak of its complexity, straining under the weight of a century of accumulated rules, regulations, and assumptions, right before it's completely disrupted. The story of risk has always been the story of how we attempt to predict the future by quantifying the past. First, we use crude tools: age, gender, zip code. Then we refine them with more personal data, credit scores, and driving records. Now, with telematics, we are using real-time data to create a high-definition portrait of present behavior. And soon, with autonomy, we will shift to assessing the risk of the technology itself. The struggle is real, and the path forward for anyone labeled high risk is undeniably difficult. It requires diligence, patience, and a deep understanding of the game. But it's crucial to recognize that you are not just a player in this game. You are a witness to its fundamental transformation. The very ground is shifting. The challenge is no longer just about finding the best rate within a broken system. It's about advocating for fairness and privacy in the new data-driven world. It's about preparing for a future where the most important safety feature isn't the airbag or the anti-lock brakes, but the version number of your car's software. The driver's seat is changing, and with it, the very meaning of what it is to be a driver, high risk or otherwise. And that is a journey we are all on together.